Hi, it's Friday afternoon in Hawaii. None of us are in Hawaii right now, so it's Saturday morning for the rest of the world. We are going to start our Friday investment talk. It's the middle of July. The best 2 weeks of July have gone by. We're headed into the rough period now for the next 2 to 3 months. Before we go into that, let's talk about inflation, the economy, Europe, and some of the stuff that is the hype in the market still. So, Alan, you wanted to start with some graphs. I think lumber was the key, right?
We've talked about lumber in the past, huge upswing, as you can see. And then, the market's cooled off hugely over the last few months, which is an indicator that the inflation is transitory, that these are not things to worry about, and that should be positive. In fact, I was actually reminded this morning, the period after 2008, interest rates didn't rise for 10 years when people were always kind of on the lookout for inflation and on the lookout for, that's after the global financial crisis 2008, that, interest rates were expected to rise because they had been taken down to basically zero. And it took 10 years. So we could be in the same position with after the coronavirus recession, that interest rates won't rise quickly. Basically, inflation proofing your portfolio was an interesting theme this week. That there was a lot of talk about that, and dividend paying stocks, which is always a popular theme for our clients and our colleagues. If you actually look at this, that's the purple line that you see there is the dividend ETF this year compared to NASDAQ. So if you think that NASDAQ did well, dividend ETFs doubled the return of the NASDAQ this year, which is really quite something, I think.
Especially since March, because that's
Right.
when we've had that pullback.
That's when inflation fears really resurfaced, and that's been a constant theme. So we're not sure that's going to continue. But what we wanted to focus on was a couple of decent dividend paying stocks that are quite similar. So we thought we could compare a little bit the two. One of them is AT&T.
Yeah.
And so one of the main attractions for AT&T is their dividend, which was laterally about 7% effective yield, which obviously is very impressive, especially for low risk investors, pension funds, those kind of guys. And I thought we'd look at, well, first of all, there was a big sell-off recently, and that was when AT&T reduced their dividend. They slashed it to 4% effectively. From 7%. There's a couple of things that people are worried about going forward. That even that 4% dividend, is that sustainable? Next year, AT&T expect to spin off Time Warner and First Direct TV. And they've actually been the major growth engines for AT&T over the last number of years. For example, Q1, Time Warner's revenues were up 9.8%, but the rest of AT&T were only up 2.7%. So it's really Time Warner that's been the engine for growth. Now, if AT&T sell that off, that's obviously a short-term boost, which is great. But where are AT&T getting the revenues growth going forward? That's the big worry, I think, from a lot of those analysts and from a lot of investors, that basically they don't see the dividend is that sustainable. And especially if you compare that with Verizon, which was the other one that we looked at, which also pays around a 4% dividend, 4 to 5% dividend. So it's very similar. I don't know, that's a 1 year chart, Chris? I don't know how far
couple years, yeah.
Right, but even that is showing much better stock price growth than AT&T. I mean, AT&T is much flatter. So Verizon are similar in a way, obviously telecoms related, same kind of dividend. They've acquired Yahoo and AOL, and they're trying to get rid of them for quite a small amount, 4.2 billion. Where Verizon is more interesting for investors, both on a capital growth and sustainability of dividend, is actually their 5G licenses. In the US, they've spent $53 billion on 5G licenses. They actually bought up 62% of 5G licenses in the US that were up for sale in the last couple of years. and they expect to sell to buy another $10 billion worth of 5G licenses. That's what they put on that. So the worry from investors' point of view is that they need to then get that growth to pay these huge sums of money that they've obviously expended to acquire the 5G licenses. But I think investors are generally quite comfortable or confident that they can do it. It's just a question of when, how quickly that can be recouped. But yeah, certainly, Verizon seems to be a better play if you're looking at a dividend-paying stock that the dividend is sustainable, and that it's actually the earnings per share growth is sustainable, and that there's a much better business plan, I think, involved than AT&T. That's certainly the thoughts of the analysts anyway. So that's kind of where it's interesting, I think, for us.
Yeah, that's good, because we actually I saw an analyst this week came out with a buy recommendation on Verizon itself as it bounces off this 55 level, and it's at 56.46, and I think it can run back to new highs here and test. So yeah, this is a value kind of play, maybe a safe play for the summer. There's very few of these safe plays, so this is kind of interesting. Yeah. Did you want to look at some of these other charts?
I mean, we can basically, because that kind of folds into the market weakness, I think, especially in America. So again, these are recurring themes that regular viewers will be aware of. I mean, this is an interesting one. Veronica's talked about the normalcy chart. I think that's an economist graph. And this is actually similar from Bloomberg and Market, but it's basically just a collection of PMI figures. And obviously you can see last year, lots of red figures around April, May. That was when the coronavirus really was at its peak and hit pretty much all of the world. There was very, very few areas that kind of survived that part. But most, as you can see, as we move into second quarter, you can see the market, the PMI figures are improving. There's a couple of three or four notable ones that are weak. That's India, Russia, Turkey, and Mexico. Mexico has really been struggling. As you can see, it's just not been in blue at all. But if you take most of the EU markets, obviously US, Canada, even Brazil is kind of rebounding back fairly strongly, considering what a mess they've had regarding coronavirus. So that's all very positive, I think. That's good for the short term or the medium term, if those are sustainable.
Yeah, I had an interesting statistics here. I read this came up. It says that in the last 3 weeks in Moscow, 170 restaurants have closed. Okay, and that's compared to the whole of 2020, when there was 208 that closed. So a lot of these places, India, Russia, Mexico, are still struggling. I mean, not maybe in the surface on the news, but except for maybe India, but they're still struggling from the coronavirus, and the lockdowns are, persisting, especially in the UK. There's
the UK is an experiment, unfortunately, right now, for better or worse. I mean, they are basically said go back to normal as much as you can, because there's such a high level of people. Not everyone. It's still not herd immunity apparently, but there's a large percentage of people have been immunized. So you're seeing huge amount of cases, 50,000 cases, I think, in the last week in the UK, but very, very few equivalent hospitalizations and very few equivalent deaths compared to what it was in early this year over Christmas and New Year, which was pretty tough. It's interesting. You've just reminded me. It's a bit off topic, but interesting statistic that I was listening to about the reopening and about airlines in particular. And there was more airline bankruptcies in 2018 and 2019 than 2020. When airlines didn't fly. And it was basically because of government intervention, either buying shares, equity stakes. The German government has a 20% share in Lufthansa. The French government, I think, is more than 30% in KLM Air France. Or other US airlines in particular didn't get equity stake. The government didn't take equity stakes, but they took loans from the government, but they're actually being paid back very quickly in many of the US. The main
Right. A lot of these airlines were bailed out or given subsidies or something to stay alive.
Yeah, but they're actually paying them back.
Right.
Which is
And airfares come back, but these charts look, this is the sell-off. They barely made it back to the point where there's a long way to go here.
Well, it's going to take 2024, I think, is the estimate when it's back to 2019 levels.
Yeah. So one other thing that's interesting, though, in Moscow, I was just reading, besides the 170 restaurants closing compared to 2020 when 208 closed, was now that, the governor of Moscow said, look, there's no more QR codes, you can open your restaurants. So now the restaurants are saying, like, we've suffered so much, and the government is doing similar what the UK is doing. Like, it doesn't really matter. We need to do something. We need to open the economy and change things. So we're going to run the risk of seeing widespread, I think, cases again. But that might not have the same effect on the economy that it did, when it was all shutdowns all this time. So I think there's going to be a trade-off between more real damage for human life, but at the same time, maybe better business. So we'll see how that goes out. I saw the Netherlands had lots of cases and they closed down again this weekend. So
they're in the red list.
The red. So Spain's in the red. So there's a lot of different. It's very interesting to see how all these different countries.
And it's middle of the holiday season, so a lot of the Mediterranean countries are opening up because they desperately need tourists from other parts of the world to come and sustain their tourism industry. If you want to go back to some of these charts, Chris, that we looked at earlier, I mean, basically it's a recurring theme that Europe is still undervalued. We still see it undervalued. That doesn't necessarily mean it's ready to grow hugely. I mean, this is basically mostly it's MSCI World, but it's obviously quite heavily weighted to the US. So you're seeing, and the first X rosette, the red rosette there, that's basically the prediction for, that's the earnings estimates that are being currently fixed right now. So that's what people are expecting it to go to,
a huge
based
leap,
on the valuations. And if it doesn't go to there, it's a problem. So and this just shows to me, you've got a huge differentiation between USA and the world ex-USA.
Right, we've talked about that, the values in some other places.
That's
and some of those values are coming back now, especially in these beat up places like India and Russia. So
I think it's a bit of both. The valuations in the US are particularly high. But actually, some emerging markets haven't done very well. They've obviously been very hit. Southeast Asia's been hit. Other parts of Latin America has been hit. Brazil and Mexico, for example. There's a number of charts that reinforce the same thing: is that America is overvalued. America is expensive to buy. This one, just so that people are not confused by the previous chart, where it looks very similar. This is PMI on the service sector,
right? Which
obviously has been badly hit. Many of them have been badly hit because it's obviously hotels, it's leisure industry, catering, and restaurants, etc. There's a lot more red this year, but it is still gradually getting more blue. And ironically,
Russia's doing much better. Russia's doing much better in the service sector. I mean, it's and you can see that in a lot of these places, whereas India still suffers a lot. Brazil's been suffering.
And surprisingly, Japan.
Let's move on to some other differences in how we approach the IPO, the PE, and the VC markets, right? Venture capital, private equity, and IPOs, the things that really get those Russians excited about investing. Whereas the rest of the world are like,
we get a lot of requests and questions, and please give us some offers, funds of funds that offer venture capital, especially people interested in fintech. And I was going to show you some graphs from economists.
I love these charts, Ron. I love these. These are the great ones.
We can see, like on this chart, how much more money is pouring into venture capital, especially fintech. It's more than usual. There's more demand from investors as they, of course, hunt for more returns. But it's also this digital revolution in finance is taking off and has been taking off. So, but it also reveals something more profound. So, because fintech firms are becoming part of the establishment, they are going mainstream. And as you can see on this chart, in the second quarter of the year alone, it attracted 34 billion in venture capital funding. And 1 in every $5 invested by venture capital this year actually has gone into fintech. Another chart shows that venture capital firms have sold 70 billion in stakes in fintech startups so far this year, and that's nearly twice as much as in all of 2020. And that included 32 listings. Fintech took part in 372 mergers in the first quarter, including 21 of 1 billion or more. Fintechs are gaining critical mass. Their value has risen to 1.1 trillion, equivalent of 10% of the value of the global banking and payment industry. But it's the new features, what's different from what's happening before, the new features is that it is increasingly focused on the biggest firms. And also it used to be fintech stories centered on America and China. Now, finally, Europe is catching up. And we can see, you probably have heard of companies like Klarna, the Swedish company. It's worth 46 billion now. Revolut with Russian roots, but London-based neobank. It's worth 33 billion now. Some firms in Latin America and Asia, like New Bank, it's Brazilian bank that worth 30 billion. I also would like to talk about some risks that all investors face going into fintech and venture capital going now. Like, for example, Visa is buying, you've heard of Visa buying Tink, but it bought at a price that is 60 times the startup's annual revenue. That's not normal. Wise is valued at around 20 times its revenues and 285 times its profits. So banks in particular may find out about promising fintech firms only once they're too expensive. So we offer to our clients who have over $5 million, we partnered with Morgan Stanley. So if there is really interest for qualified investors, they can work with Morgan Stanley to find the interesting deals in venture capital. For investors with less than 5 million, there is always MindRock partner that we discuss and offer that brings new deals on a regular basis. So that's also available. Another risk that I did mention that founders of startups show that actually some startups, when they're bought by banks, the founders of the startups leave normally in 1 or 2 or 3 years. And then kind of this startup is either shut down or sold. So prices actually may be stretched today for some fintech companies, for startups that I mentioned before. And some firms may flop, but in the long run, it seems likely that this share will only rise further. That's why there still will be boom and there still will be interest in that.
Yeah, Revolut this week in London was the biggest ever tech IPO in the UK. It's quite something.
Yeah, 33 billion, right, Ron? Is that what you said? Something like this.
Huge value.
Yeah.
It's worth more than NatWest Bank.
That's the thing. I think some of these valuations are just pretty incredible. You're talking
That's exactly what was the issue with them. They're too expensive.
Yeah, I mean, you're talking about simple money payment transfer systems with really pretty thin margins, and I mean that's the whole point of these things. They were set up as almost hobbies, and they're getting.
But like a lot of
even Wise that everyone's used it is, as I mentioned, it's valued at around 20 times its revenues.
I mean, a lot of these discounters, though, what their business model is to basically offer it for free, gather subscribers, and then start to charge. And that's
Isn't it
what,
always the same, Alan? It's the same thing.
it's always the same. But that
We'll-
just, there's
we'll
going to be
get to-
another one.
Yeah.
Yeah.
We'll get to the charging and the money making later in the future. Just give us money to get the subscription.
And get what do they call it? TAVs, is it?
Yeah,
What-
TAMs. TAMs. the
TAMs,
total
accessible
available
market.
markets. The reality is, how do you convert this into money? So it's
That's right.
interesting. I think there's definitely signs of hype here about this, and everybody's into fintech, and now before it was in EV cars, and yeah, that hot money moves around quick. So you can see that.
Yeah, the Swedish fintech firm is actually Klarna. It's
Mhm.
actually their whole motto is buy now, pay later.
So Apple's coming out with all this stuff
Yeah.
about how to change. They're going to redo the whole idea of a credit card. Buy now, pay later. So yeah, I want to bring up the markets and get going here, just to close this out of how things look for the rest of the summer. I am not going to bring up our blog, but there is a blog on our website about how NASDAQ has given its seasonal sell signal. You can read that if you're a subscriber. But in general here, the S&P 500 has been on a rip here in most of June and beginning of July here. It's made all new all-time highs. But these last couple of days, especially yesterday, there was big reversals where the market opens positive and then just sells off. And this was really the case yesterday. I don't know, you can't see, but you can see here. This is the big sell-off. Warning signs, I would say, for the market. There's lots of things that we can discuss, but the big one is the put call ratio has been on a sell signal now for about a week. It's an early warning signal. There's other signals here that show that the market could begin a more serious sell-off, with the breadth acting pretty poorly in the market, and that basically the number of new highs to the number of new lows is really slim now. And when that switches over, the difference between the number of new highs has been bullish for nearly all the last 15 months, but that's beginning to weaken, writes McMillan. So when that happens, you're going to see really the potential to have a longer, more sustained sell-off. You can see the market, although the S&P 500 looks rather well. I'm going to bring up the IWM, which is the Russell 2000 index, and that's already sold off and sits here at a pretty critical level of support that it has held since the beginning of 2021. So it needs to hold this level, which is pretty precarious if the market's going to start selling off in the weakest part of the year. So really warning signs here that this could go much stronger, much more powerful to the downside. So take heed of these warnings, especially as we head into the summer, late summer months, and the weaker period of the year. Things can get kind of unraveled pretty quickly. I do want to point out that, Alan, we mentioned a little bit about interest rates, and I brought up the chart briefly, but I'll go back to it. The 10-year treasuries have come down, and that we're sitting at this level around 1.2, 1.3% now on 10-year treasuries. If this does start to go up again, we might see a rebound in the stock market. But if it continues lower, because basically shutdowns or the Delta variant of the coronavirus, if we get continued lockdowns, shutdowns, or just lack of travel, lack of like what's happening in the Netherlands, we might see PMIs turn south again, service index turn south again, and some of these, as you pointed out, with lumber, some of the inflationary things go south again. Interest rates will go south, and that could change a lot of the fortunes for banks and some of the stuff that's been run up because of higher inflations, which have been holding the market up, some of these value stocks. So we're careful with that. I just wanted to bring up this cool chart here that not all bonds are created equal. And so with higher levels of TNX, or the higher levels of the rates, you've seen a sell-off in long-term treasuries, in immediate-term treasuries, and aggregate bond indexes because they're highly correlated or negatively correlated to increases in interest rates. So they'll go down when interest rates go up. But senior loans and high yield bonds and convertible bonds have performed well because they're actually positively correlated. So you need to really actively manage a bond portfolio. We've discussed that in the past. And people who are stuck in these kind of long-term conservative bonds have suffered this year pretty heavily with the increase in interest rates. So we need to be careful of both the interest rates and how that affects bond yields. But I wanted to bring up, I think the last thing I'll talk about today is the US dollar. And we have an extremely oversold situation in the euro right now, which against the euro, against the dollar coming up against resistance here. I don't know if you can really see this on this chart, but there's quite a level of resistance around a little bit above 25 on the UUP here. So if this where we're right at right now, and this is rolling over, so we may see weakness in the dollar coming up and some strength in the euro. So it might be a good time to get back into the euro in the next few weeks in the summer, especially if interest rates pull back. So you see the euro sitting here on its support levels, whereas the dollar is coming up against resistance. So kind of a turn of fate for maybe the euro and the dollar, which is, I know, is important for some of our clients and just investors in general to watch. So if we see the dollar fall, usually the US market will correspondingly fall with it, and you might see some strength in euro and eurozone stocks. So that's what we're looking out for. The small caps have been selling off. They sit on a level of support that they probably, in my opinion, probably won't hold here. And the larger markets are up against resistance again, and probably going to sell off too. So we have some sell signals on the market, and that's what we should be concerned about. And I think that's it for this week. Have a good weekend for the rest of it, and we'll see everybody next week on Friday for our next investment talk. Thanks. Bye-bye.